Today's episode is brought to you by Curve, a card and digital wallet service. You'll be hearing more about Curve later on, but for now, let's get into today's interview. I am joined once again by Andy Constan of Damped Spring Advisors. Andy, great to have you back.
Jack, it's a pleasure.
So, Andy, you've worked with some of the most successful macro investors in the world, but my audience already knows that. I want to get right to it, Andy. I've known you as someone who, you like to be long because over the long time horizon, people who are long win and people who are short lose. However, it seems to me that as of this timing of January 11th, it seems to me that you're kind of leaning on the bearish side. Would that be fair to say, Andy?
Well, I'm short everything, so I guess in some sense that's bearish. But I think it's very important to understand what that really means and how much what my bet is depending on, and how I think that all plays out. And I would say it's a medium view. It's not a pounding the table view at this stage. But yeah, I think assets are going to struggle. Now, what's fascinating is we're in a position in which, at least in the U.S., the economic picture is there's useful debate on what the next year will bring, whether it'll be a soft landing, a non-landing where the Fed needs to do more, or whether the Fed's already done enough and we're bound for a recession. And I'm not really taking a view on that in my positioning, in that I don't want to choose right now. I don't know how to, and I don't want to choose whether a recession is imminent, which means early, in the next 6 months, or if the Fed's going to need to do more because the economy remains strong. And so I'm just not expressing that view in a direct way, because bonds will do well in one circumstance and stocks will do well in another circumstance. And my overall view is just assets won't do well versus cash.
And why is your view? Why are you short everything? Why do you think stocks and bonds will underperform cash?
So in both of the extremes, so there's the soft landing, and that's where I lose. And in a soft landing, the economy growth falls to, let's call it trend, maybe slightly below trend, with some unemployment, but not a lot. Nothing that anyone would call a recession. And inflation magically goes to target rapidly. And we're going to get a CPI tomorrow, which undoubtedly could actually have a negative headline print, which, is a data point. We can come back to whether I think data points are useful. They're generally noisy. But a soft landing is one in which the central bank can go to neutral in terms of accommodation. And that would presumably we're in a period in which, and it's unclear about this, but presumably we're in a position in which financial conditions and interest rates, et cetera, are restrictive. And the process of going from restrictive to neutral, I don't call it a pivot, but call it whatever you will, should be bullish all assets, and that would hurt me. So my trade would lose money in a soft landing. But in a hard landing, in a recession, where people lose their jobs and in which people struggle to pay back the debt they owe, and because their incomes are down, because spending is down, and because one person's spending is another person's income, which also applies to the federal government regarding tax receipts and et cetera. Money gets tight. And when money gets tight, assets need to be sold to raise money. And obviously money's tight for anyone. And the buyer of those assets demands a concession, which is a risk premium expansion, a multiple contraction if you're thinking about equities. And so in a recession, bonds do very well. But equities earnings expectations are for, right now between 225 and 230 for 2023. And then, frankly, the recession is expected to be quite brief, if at all, because 2024 earnings are a 5% growth rate, and 2025 earnings are, I think the aggregate growth rate over that 2 years is close to 15%. So there's quite a bit of optimism regarding earnings. And, I've looked at past recessions, and a 20% drawdown from year over year earnings is not unheard of. And, that would obviously cause stocks to fall quite a bit if we were to have a recession. And I believe that stocks would underperform more than bonds would go up. And so my position would make money, because financial conditions have tightened. The same thing applies to higher for longer. In a higher for longer environment, stocks could actually do okay as nominal growth stays high. And that nominal growth supports earnings that could actually surprise on the upside. And growth can surprise on the upside, and inflation can surprise on the upside. All three of those things are, two of those things are very bad for bonds. Very bad. Couldn't be worse. And at the same time, the Fed would then begin hiking more to get back to restrictive conditions. And that would be a tailwind on a headwind on all assets, including equities. So while equities might see an earnings increase in a higher for longer environment, bonds would sell off, which means the discount rate would go up for those earnings, which means the multiple would contract, and financial conditions would tighten, which would result in further multiple contraction. So I think I win on those two, on those two destinations. And there might be other destinations. And I think when you get into other destinations like, higher for longer but weak economic growth, you can sort of think about the relative performance of assets, but you don't get away from this tightening financial conditions. So there are many outcomes for an economy, but in a recession, things tighten regardless of the relative inflation or growth. And in a higher for longer environment, regardless of the relative amounts of growth and inflation, the Fed tightens. And so it's really only the soft landing in which I think assets can outperform cash. Because remember, cash is earning 4.5%. And so when I short an asset, I get to receive 4.5% on the proceeds. And so now my bogey is, if assets rally 3% over the course of the next year, I still make money.
So those two sort of bullish scenarios. One is a soft landing where the economic plane lands very gently, and nominal growth goes down and inflation goes down, but without going into recession. Then there's the pivot case where there is a somewhat of a mild recession and the Fed pivots, but it's not that bad of a recession. So in both of those environments, you call those the blue pill paths, the blue pill scenarios that the market is currently pricing in.
Right.
The red pill paths.
Matrix thing.
Yeah.
Sorry about that.
It's great. I love it. Is the quote overdid it case, which is a deep recession where stocks perform very poorly, bonds might do well, and then the higher for longer case, which is a phrase you coined, where the Fed has to stay high, and we might get 5.5% Fed funds, might even 6%. So why do you think that the blue pill scenarios are the likelihood of that happening are less than the market is pricing in?
Well, I mean, that's the question, isn't it? My work in terms of where this trade breaks even, in terms of, and you can just pencil out, I penciled it out. I may include that in a future post or Damp Spring report, but I penciled out the outcomes. And you look at those outcomes of each of those things for where the S&P would go, where the bond market would go, and you look at the returns, and it appears that you have to get about 30% probability of a soft landing based on current pricing with that scenario analysis. Now, you can do it in a far more sophisticated way, but just for your listeners, just pencil it out. Look at what you think bonds would do in a recession scenario, what you'd make in bonds if you're short, what you'd lose in bonds versus what you'd make in equities. Look in there's only three scenarios, and you pick all three, and then you see what would result in no expected return for for that portfolio on a probabilistic basis. And so that's a simple exercise that anyone can do. And my rough number is about 30%. Now, the question is, what is that a good number or is that a bad number? And soft landings are extremely rare in history. But I think the reason why I think it's lower than 30% is primarily due to the forces that are at play. Um, this isn't just a normal landing where the economy is weakening, the Fed is tightening, and their tools are particularly responsive to changes in the economic climate. Meaning, we're in an economy that's a goods heavy economy that where there's lots of borrowing to finance, and where their tools are very responsive. We're not in that world. And at the same time, the size of the fiscal spends, the size of the monetary accommodation, to me represent, just bigger forces that are going to swing the damped spring model of price discovery to, more volatilely. And actually, I think that's great because we still don't know. And so now the swings are actually creating trading opportunities until it's resolved. But those forces are very large. And I think what's missing from other soft landings is it's really uncoordinated globally. With China reopening being the extreme case where they're just, they're where we were in summer of 21 when we first heard there might be a vaccine. We were all at home. And, that coupled with stimulus that subsequently happened and that the PBOC seems willing to do, and they sort of have to because they have the housing deleveraging that they need to overcome, is very different than where we are. And Europe is somewhere between there where, their tightening cycle has just begun. And they are not restrictive. They are still stimulative. And so those forces, we're a pretty insulated economy with, our GDP being, 85% or so domestic. But those forces will make capital flows from asset to assets a challenge to deal with while all these other pressures are at play. And so I guess what I just say is that they may stick the landing, and but I think along the way, even if they do stick the soft landing, you're going to have lots of opportunity for trading in and out of this type of position. And so, that's really my agenda.
Right. So the that's one of the blue pill scenarios. Let's talk about the red pill scenarios. The higher for longer, where the Fed just keeps rates at 5% or above that, as inflation is really sticky in that scenario, and then the deep recession scenario. I think in the higher for longer, you maybe want to be short both. Is what we were saying, and in the recession one, it's good to be short stocks and long bonds. How are you weighing the various probabilities of that, given that you said that the odds of a soft landing you think are less than 30%?
I think that's more of a coin flip. But frankly, I think it's also possible that the market is favoring one. And in fact, I think they're currently favoring a deep recession. The reason why I say that is bonds have outperformed stocks lately. But more relevantly, the cuts in relatively quickly in Fed funds over the course of the next, call it 18 months after the peak, and the peak itself of short-term rate path, are both very bearish as it relates to the economy. Currently, terminal rate is 5%, and the Fed has a higher rate penciled out. And after the terminal rate is hit, but between June of 2023 and Dec of 2024, almost 200 basis points of cuts are priced in. And that's a substantive cut, taking us back down to 3% on Fed funds by the end of 2024, which is well ahead of the SEP. Now, no one believes the Fed, but I've done this a long time, and I haven't seen the lack of belief in the Fed in a long, long time.
Right. So, Andy, as you said, that the forward interest rates are pricing in the Fed gets to, I think, like 4.93%, so pretty much 5% in the spring of 2023, and then many, many cuts. I think 50 basis points of cuts by the end of 2023, and 200 basis points by the end of 2024. So, in what environment would the Fed do 8 rate cuts after hiking? Would it be just because Jay Powell wants to throw a bone to the bulls? No,
Yeah,
it's because there's a deep recession, right? So the market is pricing in.
I don't see a soft landing being something that would require such rapid rate cuts. We don't want to get.
Absolutely, I agree. I'm saying the reason it's saying, like, I think Neil Kashkari said, oh well, the forward basically the short-term yield curve inversion is because the market is believing in Fed credibility or our ability to fight inflation. But I'm saying no. It's a 200 basis point cut. That would be one in which a deep recession would require accommodative monetary policy.
I sure think so. Anyway, I think that's a bet to make, and it to some extent it hedges my exposure to this idea, because I think there's it's obviously betting one direction. If you bet, for instance, that there are going to be fewer rate cuts, you're betting on a higher for longer for sure. But it's also possible you're betting on a soft landing. So it's sort of, I like opportunistically adding that to my book, and where I bet against the number of cuts that are priced in, because I think I can win on a soft landing, and I certainly don't mind having a trade that can win on a soft landing and win on a higher for longer, because then I have 2 wins on the higher for longer and neutral in the soft landing. Now, it's possible the soft landing is a rate cut, a substantive rate cut. But I think there's more to it. I think there's just extreme, in the short end of the curve, there's extreme. And I think it's also classic in that for 40 years now, inflation has come down rapidly, and the Fed has needed to stimulate. And so I think people are playing, PIMCO said bonds are great right now because there's a recession coming. They might be right that there's a recession coming, but the idea that the Fed will pivot is the classical thinking of 40 years of being trained. And I'm just not so sure of that without significant recession.
And how would you structure a trade in the short-term interest rate world to structure that? If the curve is pricing more hikes and you think they'll go down, you buy treasury yields, or like Eurodollar futures, something like that. But how do you structure a trade?
I'll tell you what trade I'm doing.
Yeah.
The trade I'm doing is, and it's not perfect because there's an issue on what the terminal rate is, and if the terminal rate gets. Well, anyway, let me tell you what it is. So the first thing is it's long SFRM 3, which is the June SOFR 3-month contract, and short SFRM Z4, which is the 2024 December contract. And so that captures, right now it's trading about 190 negative. And so that captures mostly what I want. So there's a little bit of trick to it in that if you believe that the terminal rate is actually 5.5, it's possible that on that journey to 5.5, your long will actually lose money and your short won't go down because there'll still be expectation of 3% 2 years from now because they overdid it. So there's a little bit of trick to it, but that's the what I'm doing because I think that risk is low.
And would that trade, and by the way, for folks, if they look this up, just so you know, a 97 basically means 3%. You just take 100 and you minus that. With 3 months, it's different because of the timing and everything. But if someone told me that, it would save me a lot of headache.
Right. Euro-dollar futures, SOFR futures are all roughly, Fed funds futures are all roughly, and there's some basis that you have to deal with, but roughly the rate that you expect is equal to the price, 100 minus the price.
Right. And, I think I have a perfect definition of carry, but my definition is, if you own a 2-year treasury note, you're getting paid 4%. If you want to short the 2-year treasury note, you have to pay 4%. If you want to go long a REIT, you get paid the dividends. If you want to go short it, you get paid the dividends. Is your trade of long a certain June SOFR 2023 and short the December 2024, I think, is that a positive carry or a negative carry position? And to what degree does that depend on the curve?
Well, that's a complicated question. I think it's better to look at a trade that a lot of people are talking about now, which is, and we started the conversation with, which is curve steepeners and flatteners. And so if you think of a 2-year at 420 and a 10-year at say 360, if you think that the 10-year rate is going to go up and the 2-year rate is going to stay flat, so that would be a bear steepener. Did I get that right?
You did.
Yeah. In such a circumstance, you would want to short the 10-year note and buy the 2-year note. And that trade would cost you in daily interest cost. Now there's financing and repo, which we're not going to get into, but the 10-year interest rate that you're paying because you're shorted is 3.6, and the 2-year rate is 4.2 that you're receiving. And so that has what would commonly be called positive carry. And that's an interesting hurdle now for buying long-term bonds versus keeping your money in 2-year money, because right now you forego 60 basis points of interest when you go out to the 10-year point on the curve. And so in most environments, when you have a positively sloped yield curve, it pays you positive carry to be long-term bonds and short-term bonds, or financing overnight on repo your short-term bond. And that doesn't exist right now. So there's a fairly big hurdle for investors to buy bonds. Now, there's been animal spirits and bonds have rallied, but it is a hurdle that you have to be aware of.
Hey there, I hope you're enjoying today's show. Just wanted to let you know that this episode is sponsored by Curve, a payment service that gives you power over your finances. The way it works is that Curve is an extra layer on top of your credit and debit cards that gives you additional cash back on the rewards that you're already earning. Curve Card has no foreign transaction fees, and you can choose to earn your rewards in crypto. You don't have to, but you have the option. Curve Card also has a feature called Go Back in Time, where you can retroactively change the card used to buy an item after you made the purchase, up to 30 days after, actually. A key concept in finance is optionality. When you have the option to do something, but you don't have to do something, this can be very valuable in finance as well as life. And optionality is exactly what Curve gives you to do with your wallet. So check out Curve to get $20 once you've downloaded the app and made your first transaction. Curve Card is powered by Hatch Bank. Terms and conditions apply. Now, let's get back to the interview. Now, Andy, I want to get your thoughts on stocks. They're valued based on the future cash flows, and obviously those profits go down in a recession. They're also valued based on a discount rate, and that is the interest rate that's set by the Fed to some degree. So it's a really complicated valuation of many different ways. But what's your outlook on stocks and why?
Yeah, so again, it comes down to knowing, which I don't, whether we're heading toward a recession or a or a higher for longer or a soft landing. And the dynamics at play, I think, are relatively straightforward. It's a combination of earnings, discount rate, and risk premium. In the reason why I'm short equities is for the same reason I'm short all assets, is because I expect risk premiums to expand as a predominance of the scenarios indicate financial tightening. So that's a multiple issue, which is I don't expect multiples to expand. I expect them to contract. And then there's the earnings. And I would say the dynamic on earnings is going to be a very interesting one, and not what we've experienced in many, many decades, in which it's going to be a tug from weakening growth downward for earnings, but at the same time, nominal growth potentially remaining strong, and down a level, top line inflation being at a different time and place than input cost inflation. And so that'll have that'll really have an impact on margins and top line. So in a higher for longer scenario, I could imagine labor is actually less tight than people think. And so wage inflation is weak, is not going to continue to grow as quickly as it has. And CPI will stay high, resulting in high top line, resulting in higher margins, resulting in higher earnings on an absolute basis. And that's quite bullish for stocks. But I can imagine that scenario. I don't think that's what's playing out. If you look at top line inflation over the last 3 months, we're sort of flatlining. Are we dipping? Maybe we're even dipping, but we're certainly flatlining on top line inflation, which should be isn't creating revenue growth simply due to inflation, while wage inflation continues to be fairly robust and not looking like it's turning in a meaningful way. It's many hundreds of basis points higher than CPI inflation. And what I call that is we've left the sweet spot where CPI inflation was in excess of wage and input cost inflation. And so that was good for top line, great for top line because you're having top line inflation, and also good for margins because your costs are not keeping up with your ability to raise prices. And I think that was the story of 2022 on why stocks outperformed bonds fairly substantially for most of the period, is that
bonds don't have a top line.
Right. Bonds are pure inflation. And so you're gonna feel it when you get inflation, and it's only one kind. And so that play is interesting. And that's why I say there's probably shades of gray on a higher for longer scenario, one that can be very bullish for stocks. I don't think that's what's happening based on, as I said, we're leaving the sweet spot. In fact, I think we've probably left the sweet spot as CPI is now lower than wage inflation. But we could return to that sweet spot. Then there's the alternative, which is margins get compressed, but top line still remains relatively robust. And then you could meet expectations. And then you start getting into the discount rate. And well, in all cases, the discount rate matters. And the discount rate in a higher for longer scenario with the 4.5% 30-year bond, say, or something 50 to 100 basis points more than we're at, that's going to leave a mark on equity valuations as well. And so the higher for longer case is bullish for equities because of top line. That's pretty much it. Its headwinds are tightening, discount rate, and costs. And I add that up to still stocks. In my higher for longer scenario, I think stocks could be 4,200 pretty easily. Are they going to be 4,500? No, that's sort of my soft landing scenario.
Mm-hmm.
And so, again, I recommend you pencil those things out on where each of those scenarios are, and you'll find sort of implied odds based on that simple calculation. And right now, to me, the odds of so what when you take more than just the penciling out, and you look at the priced in the outperformance of bonds over stocks lately, the priced in cuts in the short-term interest rate market, and the market is favoring recession, not favoring higher for longer, and liberally believing in a soft landing. And so, if you like to fade things, higher for longer is probably the better fade than a recession. Recession seems hard to fade right now.
Right. So you've got some excellent charts from your report on the damn spring that, with your permission, we can put up screen in post production. Analysts, the street, Wall Street, forecasting a 5% growth in earnings, so $229 per share of an S&P, and the S&P 500 now trading at 39.20 as we record just close to noon on the 11th of January. So that's a forward price to earnings ratio of about 17. And all assets are in competition with each other. So if interest rates are, let's say the 10-year is now at 4%, it's lower, but let's just say it is. That's a price to earnings ratio of 25. But then you have to have a little premium on top of that. That's an equity risk premium. And you're saying that too is historically low. So you're saying that either if earnings grow as much as analysts think, or even more so, that will be an environment in which rates will be high. Therefore, the competition from other assets will be high. Therefore, the forward price to earnings ratio should be lower. So it's kind of a win-lose. There's no way for stocks to win on both ways. Not no way, but
I mean, I think winning, a 5% rally this year in stocks from here is, that's a win. It outperforms cash. It's earning 4%. It's not great. I think you need a soft landing to actually have a really robust year in stocks, but we'll see.
Yeah, right.
But that's the dynamic. I think you can't expect a significant stock rally with bonds, the discount rate rising, and with the Fed needing to hike more. You just can't. I can't get there, despite pretty good earnings.
Right. You've got a chart of the current risk premium for stocks, and it's got a red line. It's pretty complicated. It took me a minute to understand it. Basically, if earnings per share fall by 10%, then the risk premium will have to be lower because just that the forward earnings are less. So the valuation will be less. So yeah, what is the current? How would you ascertain? How do you relative to history the current level of equity risk premium? How rich or cheap are stocks now, and how rich or cheap would they be if earnings per share fell 10%?
I would say that. And I've tweeted this a number of times to much derision, that the risk premium priced into markets right now, using 225, using a 30-year bond yield that's current spot, is tighter, meaning multiples are higher than they were before COVID. And so that's quite amazing that risk premiums that means stocks are richer than they were before COVID by a couple of hundred S&P points, roughly. The same applies to where equities were at the end of this last year of 2021. In December of 2021, equities were actually cheaper than they are today by a couple of hundred S&P points. And since then, we've had nothing but tightening and quantitative, both raising of rates and quantitative tightening. So that would indicate, just from a risk premium standpoint, which by and large is the result of monetary tightness and a little bit in volatility. And volatilities are about the same as they were before then. That would indicate that conditions have actually eased in the course of the last year. Now, that's possible if the economy is strong, because it's all easing and tightening of financial conditions is all relative to the strength of the economy. And the economy's been strong. So it makes some sense that financial conditions have eased along with a strong economy. But there's been all these forces that the Fed has thrown at the market to be offsetting that type of strength. And yet equities are richer than they were a year ago at 4,800.
Because equity risk premium is relative to a risk-free asset or like a treasury bond, because rates have gone up so much, most overused phrase in finance, but like stocks are like the cleanest shirt in the laundry or whatever. So they are relative to bonds more cheap, more expensive than a year ago, let alone 3 years ago. But that's just because bonds have sold off by such a tremendous amount, right?
Yep. And that's something that would happen. Now, part of that is because there has been a sort of, and when you do something relative to bonds, well, bonds have a risk premium too. And I don't want to spin out of control on this, but it's possible that bonds are so unattractive to people, long-term bonds, because of their once in multiple centuries worst performance in history, that bonds are actually for sale relative to equities. And that's part of the reason why equities look rich, because bonds are just so cheap because no one wants them. And that reflects in their relative risk premiums. But I think it's much more simple than that. You look at the amount of tightening that's been done and the impact it's had on the economy. And I think we're just in a situation where equities are just on the rich side. If gun to my head, what would be my favorite trade? It would be short equities. I don't happen to have that trade on, but that would be, I'm short everything, which is different than being just short equities.
You're short equities in addition to being short other things.
Right. Yeah, I'm short equities, but I'm short bonds and stocks and and gold and all those other things, because I don't want to. Equities will work for sure as a short in a recession, and they won't work in a soft landing or a higher for longer. But so I don't want to make that bet, because I think everyone's making that bet at this stage right now, to be honest. I think there's, as we've said, the recession is priced into many markets, not equity markets per se, but priced into many markets. And so I think it's fairly well expected. So now the question is, do you want to make that bet? And I just don't know. So I'm not making that a pure directional bet on equities. The trade to have on, if you were really thinking a recession, is long bond, short equities. But I'm short both.
Andy, you've got a chart of the forward earnings per share estimates, drawdowns from peaks. This is not actual estimates, but it's not actual earnings, but it's estimates of those things. And you can see during 2008, a huge trough, close to 45% drawdown. In 2020, 30% drawdown, close to it. So these happen, during recessions, and the bigger the recession, the bigger the drawdown in forward estimates. Right now, we're close to a 5% drawdown from forward earnings, meaning that they're only 5% lower than where they were, at their absolute top.
Yep.
Where do you think this goes? And do you have a model or an informal way of judging how low it might go?
As I said, it depends. In a recession, it's going to go down 20%. That's sort of run-of-the-mill recession. In a severe one, it could go down more. But we may not be in a recession yet. Earnings could grow this year. They could beat estimates. They will beat estimates in two scenarios: a soft landing or a high nominal growth environment. And so from an earnings standpoint, it still is, yes, if we're headed toward a recession, we're going to have a much larger drawdown in earnings than has happened to date. And if we're not, they're going to beat.
Mm-hmm.
And this is a complicated time in the U.S. It's just not clear to me that, and people have very strong opinions on whether we're heading to a recession or heading to a longer term inflationary period, for very good reasons. And it's hard to know. And so I'm just choosing not to.
Right. So the U.S. is very complicated, hard to tell. Are there any other parts of the world, maybe Europe or China, where the macro picture is clear? And then also, share your thoughts on this divergence where it's not like China and the U.S. are growing together. China is at maybe the bottom of its economic cycle, and growth is ahead, whereas the U.S. things are a lot more murky.
Yeah. So I wrote in on I guess mid-November. It's on my website at dampspring.com. A DSR about the Great Convergence, which I think is probably the trade in 2023 in the U.S. And that Great Convergence is bonds have underperformed massively equities, and that some of that underperformance will result in a bounce, an outperformance, a convergence between those two paths. But that's the U.S., and I've described that situation. I wrote a chart that describes two dimensions. One is do assets outperform cash or not? And the other dimension is do bonds outperform equities? And I plotted using the models I use to evaluate this where I think we are in the world, and it's consistent with I think what's happening globally post-COVID. And the U.S. led on the way in, both with stimulus and response and fiscal and monetary easing, and a full-blown response. And now we're at the inflationary. We may be nearing the inflationary peak of that experience. China, on the other hand, and to a lesser extent, Japan, is really at the front end of that. So, if you just sort of look at your calendar and say, where is China? And I would say China's in this, in Q3 of 2021. And Q3 of 2021 resulted in, a fairly big equity outperformance relative to bonds. And I think that's, what we're going to see in Asia. I've recently bought for Damp Spring some China equity exposure. That's a complicated trade given the rule of law issues, but it does express this view that cash is trash in China. Assets are good, and equities in particular are best. And when you go to Europe, they are, I would think, more like Q1 of 2022 in terms of their COVID response. Now they have the war overhanging and the energy issues overhanging, so they're it's a little different, but timing is different. But they are in the beginnings of their tightening phase. They're not restrictive, and so at the time in November, I suggested you want to be long. You want to be short assets because they're at the beginning of their tightening phase. And we know what 2022 did to assets in the US when we started our tightening phase. But you do want to be long stocks relative to bonds. And so, if you look at DAX and European stocks in general relative to bonds, it's been a massive win to be long stocks and short bonds in Europe. And I think that trade probably has some legs. We'll see. It'll dip and fade like anything else. But, the fundamentals are we're at the beginning of our tightening phase. That's very bad for bonds, but we're still stimulative. We're still not restrictive. And so that tends to be good for equities. So, as I run around the globe, cash is trash in China, cash is king in the US and Europe, and equities are best in China, and equities are best in Europe, and equities are probably worst in the U.S.
Yeah, that's a great quadrant you have. And yeah, your analysis of China, how much of it is occurs with the fundamental news? Oh, this official said this. This policy is being rolled out. Are you just looking at the stock market, which has exploded higher the past 2 or 3 months, or are you saying Chinese bonds have outperformed Chinese stocks over the past 2 years by such a large degree that it would be a sigma deviation for it to continue. Therefore, I think stocks will outperform bonds, or is it a mix of a mix of all three?
Yeah, I mean, you have to look at all those things. I would say that it's, the transparency around the government bond market in China and the ability for anyone to access those markets makes me suspicious about taking much direction from, and for that matter, investing in China. So, it's not for the faint of heart, and I would never devote a significant part of my, well, not never. Today, I wouldn't devote a significant part of my portfolio to a Chinese investment of any sort. But I think the fundamentals are driving it, which is there will be a natural growth impulse, potentially stimulated by fiscal policy, that will result in, the same sort of dynamic that drove equities higher in the U.S. when we came out of COVID. And we'll see how it impacts inflation. I think there's many schools of thought on that in terms of, which includes things like understanding the supply side. There's a bull case for oil, which I don't happen to share, for China reopening, that ignores their storage. That's important. You have to look at both the supply and the demand. But from the demand side, it seems like there would be excess demand for goods and services domestically, and at some level, an easing of supply as more production is able to be done by the Chinese as they come back, which is globally deflationary. But I think the goods and services demand, the commodities demand, et cetera, is probably I added up to slightly inflationary globally, but certainly good for stocks locally.
Yeah, so good for Chinese stocks. What about the impact on the European economy, American economy, and Western stocks? Like, for example, if America is booming and buying a lot of products, I presume that's pretty good for the Chinese economy. However, China consumes far less of America's goods than America does of China's goods. And, you can say, oh, well, the price of copper is going to be good because China is embarking on, again, this infrastructure spending. But, copper miners are like less than 1% of the S&P 500,
Yeah. Yeah. I mean, I think the impact on of China reopening is mild to the rest of the globe in terms of their asset markets. It's not zero, but it's mild. And it just, as I said, this is the whole situation we have is that things are not coordinated globally right now. And so you're going to see some odd impacts on that, just doesn't make the policymakers anywhere job impossible. It just makes it more difficult. And so, a slight global inflationary push, might mean that, and with an unknown amount and duration, just makes Jay Powell have to think differently about his reaction function at the margin. And those slight tweaks today have effects that last a long time. And so again, it's just, to me, it's just the controls are very difficult to make this plane land softly. And this is just another example of what's different than when you have a global recession, and all central banks are pulling in the same direction.
So, Andy, as we're close to a close, I just want to say that people can find your work at dampedspring.com, and on Twitter you are at dampedspring. One of my final questions for you, Andy, is why are you short gold, and what are your views on other commodities? I think you hinted that you don't share the bull case on oil.
Yeah. So again, commodities and gold are part of a diversified portfolio. My objective was to have a portfolio. So my objective in life is to have a portfolio that is collects risk premium for over the long term. This is what I like to have long. Collects risk premium over the long term and is diversified against inflation and growth. So I don't have to pick inflation or growth. The 60/40 portfolio, for instance, is extremely long growth relative to any other risk factor. And so I prefer, when I'm long something, to really just collect risk premium without making a bet on inflation and growth. Well, okay, what's that portfolio look like? And it looks like my damp spring beta. It looks like Harry Brown's permanent portfolio. It looks like Ray Dalio's all weather. It looks like, it looks like a risk parity portfolio of some sort. And, you short gold when you go long that portfolio, you're long gold and you're long commodities because that's what the 60/40 doesn't have. But you're not long them because you have a view on gold and commodities. You're long them for balance, not because they go up all the time. If they went up all the time, everyone would own them. You own them for balance. And so when I look to be short, I also don't want to have a view on growth and inflation. And so if the thing I'm long that I, put my long-term wealth in is balanced in this way, the thing I'm short, if I think all assets are going down, has to be the same thing. And so, yeah, that's the reason I'm short gold and commodities in this particular trade, which represents, is an unlevered. It represents 50% of my capital in my alpha account. And, is not the biggest trade I've ever had by a long shot. And my risk is relatively low because my uncertainty is relatively high. But I have no view on gold, or actually, to be honest, I think it's getting a little rich, but that's not why I'm short. I sold it a lot lower for the balance. I sold commodities a lot higher for the balance, not because I had a view.
Mm-hmm. Where would you say commodities fall within those four outcomes of Fed pivot, soft landing, higher for longer, and deep recession? Because we talked about how bonds and stocks do, but not about commodities.
Yeah, so growth is good for commodities. It's really very sensitive to growth because it's a demand asset. And it's probably, of all the assets that I look at, it's probably the least sensitive to financial conditions and term premium. In fact, spot shouldn't have any term premium at all. Risk premium at all. It's pro-growth by and large. Now, it also can be in monetary, and I've written a bunch on this, so the different, there's a lot of talk about whether gold is an inflation hedge, whether Bitcoin is an inflation hedge, whether commodities are an inflation hedge. And I think in all cases, those things are in fact an inflation hedge when the inflation is due to monetary, essentially printing. Mm-hmm. When it's due to demand that's self-supporting and people willing to lever up, it's less clear that it's a good hedge. Commodities are more reliable, but some of the other things may not be. And when it's a supply shock, it's almost certainly not a hedge. And so I've written a bunch of things on that. And I think that when it comes to commodities, it's mostly about demand. And given the direction that monetary policy is heading, in some places it's easing, like China, but in other places it's tightening, like the rest of the globe by and large. That should be a sign that the fiat devaluing reason to own any of these things is not going to be a driver. So I look at pretty much as a growth thing. And so, the longer that the real economy is strong, the better commodities will do. And frankly, the pricing that we've seen over the last, certain ones are odd, like copper, but the ones that certainly when you look at energy, and again, you have to look at everything. It could be weather, but which I can't trade. The demand side is falling with price. seems to be consistent with people expecting a recession.
Mm. Andy, final question for you. You're a veteran of the macro hedge fund industry. Macro hedge funds, some of them had an extraordinarily good year, posting returns in excess of 100%, which is truly stunning. A lot of this was from being short stocks and bonds, but and particularly bonds, because that's where I guess the biggest volatility was. And so you could say that a lot of funds were short bonds, and it worked. It was a trade that was very popular among macro hedge funds in 2022 and 2021. Didn't work as much in 2021. What would you say are the dominant macro trades at the hedge funds now? I mean, I assume there's nothing approaching a consensus, but how many people still think bonds are going to go down? Is it possible that 2023 could be as good of a year for macro hedge funds as 2022, or no?
Gosh, so I don't think it's a coincidence that when a market has had its worst year in all time, that you have a lot of people that were on the right side of that trade. Now, certainly long only weren't, so you don't see any of those guys writing headlines. Mm-hmm. Did all the hedge funds have short? Were they short the bonds in the worst environment ever? A bunch were. Did they cover? Looks like Bluecrest actually covered and went long, probably around the same time that the UK puke actually happened. They were short going in. My guess is they covered, and they're making money in both directions. Alpha is very, very hard. I think the one thing that you should take away from hedge fund performance this year is that those who have who made money, great. But what I really look for is somebody who can make money in an uncorrelated way. And so it's better to have an alpha investor who is uncorrelated to long only as a portfolio. And so, when I look at those, that's what I'm looking for. That was an extraordinary year. I certainly don't expect it this year.
Right. But negative correlation is good. And, when the 64, right? The negative correlation is good. And when 60-40 portfolio has its worst year ever, it's good to have an 100% year, right?
It's not good if it's, I agree. Negative correlation is good. But if it's perfectly negatively correlated, all you're doing is paying away your risk premium with transaction costs and fees. So you need uncorrelated. Now, it happens to be good that it was ahead, if hedge funds are making money when the market goes down and not losing it when the market goes up, that's a good investment. You want that.
Mm-hmm. I have a few more questions about beta, how you define it, carry trade, stuff like that, but we'll have to leave it for the next time I have you on, which I hope is soon. Constan, thanks so much for joining, and thanks so much for everyone for watching.
It's a pleasure. I would like to say one thing. If you notice this, my one gray beard is getting quite long. That's to support a new venture that Nick Giovannik and I have launched called Two Gray Beards. Take a look at that at twograybeards.com. If you're a wealthy investor who has found despite great effort by their asset managers and financial advisors, that somehow you're not having good conversations, take a look at that website and join us to see if you would benefit from our experience in having good conversations with financial advisors.
Yes, definitely. Andy, thanks so much.
Thanks, John.